Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about how annuities are taxed in the U.S. and what you need to know before you purchase an annuity and what's going to be taxed as you take distributions or withdrawals from your annuity. Okay, so the answer to the first question, do you pay taxes on annuities? Yes, annuity income is taxed as ordinary income, not capital gains. So that's important to know. So ordinary income is considered federal and state taxes. Think of it like you're still working and you're collecting a paycheck and you're going to get taxes taken out of that paycheck each and every year. And this, depending on the insurance company, you either have it withdrawn from your annuity payment or you'll get a 1099 at the end of the year. There are three different types of annuity payments or withdrawals that you should be aware of. Number one, there's the non-qualified annuity. This is if you bought an annuity with money that's already been taxed. So think cash or cash value in a life insurance policy. And in the non-qualified annuities, only the gains are going to be taxed, okay? Scenario number two is the qualified annuity. This is often the most popular option. Folks like to fund their annuities with IRAs, 401ks, 403bs, thrift savings plans, 457bs, and other qualified retirement accounts. And it's just like a 401k or an IRA. All of it is going to be taxed as ordinary income. So 100% of it is going to be taxed. And it's going to be taxed just like if you were earning a paycheck at work. And then the third option is the Roth IRA annuity. And a Roth IRA annuity, as long as you follow the IRS rules, which is you hold it in an IRA for 5 years, and that could be before you purchase the annuity or after you purchase the annuity, sustains that Roth IRA status with the IRS. All withdrawals and distributions are tax-free, okay? So that leads to the next question. Well, if they're taxed at ordinary income, how are they taxed in terms of when it's taxed? Is there a ratio of taxes? Are taxes coming out first, et cetera? The answer is it depends on how the income is being taken out from the annuity. So when you take money out of a tax-deferred annuity. And this applies specifically to annuitization. So annuitization, for those who don't know, is the conversion of your savings into an irrevocable stream of income. And the insurance company keeps your money and you get this fixed payout for the rest of your life. We don't typically recommend that in most cases, but if you're going that route, you're going to be taxed differently than if you were to add a tax-deferred annuity with a guaranteed lifetime income rider, okay? So with annuitization, if you have a qualified SPIA or qualified DIA, which stands for single premium immediate annuity or deferred income annuity, if it's a qualified IRA annuity, it's going to be 100% taxable. There's no way getting around it. Just know that that's going to be taxed at 100% federal and state taxes. Some things to know about that, though, is a lot of states, if you have state taxes, offer retirement income exclusions. So I would definitely look into that and see how much you can exclude. You also need to understand if you have an IRA annuity and you take annuitization prior to age 59 and a half, you could incur a 10% IRS early withdrawal penalty. So please speak to a professional if you're younger than age 59 and a half so they can give you a couple of options to skirt that 10% early withdrawal penalty, okay? With a non-qualified annuity and you're annuitizing, they're going to have what's called the exclusion ratio. And that's a ratio of how much of the payment is going to be taxable and how much of the other portion is going to be not taxable. So in the example of you had $100,000 in a non-qualified SPIA or DIA, and $50,000 of that $100,000 is after-tax money, and the other $50,000 is tax-deferred money, your payment exclusion ratio would be a 50-50 exclusion ratio. So as you receive distributions from this irrevocable stream of income, 50% of that paycheck that you earn will be taxed at ordinary income, and the other 50% won't be taxed, okay? Now, if you go the route of using a tax-deferred annuity and not annuitizing it, and instead adding a guaranteed lifetime withdrawal rider or lifetime income rider, depending on how you want to phrase it, you're not getting an irrevocable stream of income. You're getting a revocable guaranteed withdrawal for the rest of your life. And because it's labeled as a withdrawal instead of an annuity distribution, you have to be taxed like you're taking a withdrawal from a savings account. And the way that is taxed is through a method called LIFO, last in, first out. And what that means is the taxable withdrawals come out first, then you eat into the after-tax money. So in the example that we used before with the $100,000, if $50,000 is after-tax money and the other $50,000 is money that has been tax deferred and not taxed yet, as you take withdrawals, they're going to be taking out that from that $50,000 that has not been taxed yet. So you may be paying taxes on all of your withdrawals until you eat into that after-tax money, okay? So say that a different way. Let's just say you have that $100,000 fixed index annuity and you decide to take a lifetime withdrawal, and your lifetime withdrawal is $5,000, okay? Well, all of that $5,000 in year one is going to be taxable because $50,000 hasn't been taxed yet, and you're going through LIFO. And then after the first year, you're left from $100,000 down to $95,000. And now you have $45,000 left that you have to eat through, not counting any interest you'll earn, before you get into the after-tax money. At death, if it's qualified funds, all of it's going to be taxable. You've got to do it within 10 years or a lump sum. Or if you're a spouse, you can pick up the contract and continue it and keep deferring the taxes until RMD time at age 73. If it's a non-qualified annuity, you have 5 years to take it out or a lump sum, and they're going to just tax whatever earnings that you've gained while having that annuity. And then if you have a Roth IRA annuity, it's tax-free income. What other questions do we have here? A certain exclusion that I should mention, if you're younger than age 59 and a half. Oh, and going back to the non-qualified annuities, if you withdraw prior to age 59 and a half, just like the qualified funds, the taxable portion of your non-qualified status will still be subject to that 10% early withdrawal penalty from the IRS. So just be aware of that. And there's some ways to get around that. A 72T for qualified funds and 72Q for non-qualified funds. And basically what that is the IRS will allow you to get a fixed payment amount for either 5 years or until you turn age 59 and a half, whichever comes later. Then once you reach the 5-year threshold or age 59 and a half, whichever comes later. So if you're 58, at 59 and a half, you can't stop it. You have to keep going for the remaining 5 years. Then you pass that, and then you can start taking income from the annuity normally. So got to contact us here at the Annuity Expert for help with that. Another route that you can go is you could do a life non-qualified. So if you funded a non-qualified life-only SPIA with cash, you should be able to avoid the 10% early withdrawal as well. We recommend strongly to get some sort of cheap life insurance policy for the amount of the annuity investment. So in the case of if you have a $100,000 non-qualified life-only SPIA, we recommend you get maybe a term life insurance policy for $100,000 for, let's say, 20 years, okay, so that you protect your original investment in case you get hit by a bus and you die prematurely and the insurance company keeps your money. So those are just some tips and some guidelines on how annuities work. If you have questions or you have some niche questions, feel free to contact us at the Annuity Expert. You just go to your favorite search engine, Yahoo, Bing, Google, type in the Annuity Expert. You can go to our learning labs here, click annuities, And then we have the most popular topics, the annuity basics, the income annuity calculator, how to buy an annuity, are they a good investment or a bad investment, how to compare the current rates. We have even some research advice and tips here that you should take a look at before purchasing an annuity, and what happens when you die, and then how are annuities are taxed. So just come on over here. You can take a look at it. And then you can chat with us, you can email with us, or you can call us here at 770-755-1565, and we can answer all your questions. Hope that answered most of the questions around taxation on annuities. If you have any questions, feel free to contact us. A link will be in the description, and we'll catch you on the next video.